You've been told to cut Starbucks and clip coupons if you want to get rich. But if you really want to see your bank account grow faster, you need to focus on the bigger financial decisions. And that's why in this video, I want to go over the 5 most impactful financial decisions that you can make, which will change your financial life with small changes today. Starting with number 1, look at your retirement fees. If you have a 401k, an IRA, or other stock retirement account, make sure you're not overpaying in fees. And if you didn't know that your 401k is charging you a fee, you're not alone. More than 90% of Americans don't know what their 401k fees are. When you invest your money into a fund, whether it's a mutual fund, index fund, or ETF, you have to pay a fee called an expense ratio. And this fee is not a one-time payment that you make. It's a reoccurring payment based off of how much money you have invested and how much money your money made every single year that your money is invested in that fund. Let me show you how this plays out. Here are a couple of the most popular funds in the United States used by 401ks. VFIAX gives you exposure to the S&P 500. That's a group of the 500 largest companies in the stock market. And GFACX gives you exposure to the American Funds Growth Fund. The S&P 500 fund has an expense ratio of 0.04%. GFACX has an expense ratio of 1.36%, which means for every $100 you invest in this growth fund, you'll be paying $1.36 in fees. For every $100 you invest in the S&P 500 fund, you'll be paying 4 pennies in fees. Both of them might not sound like that much, but see what happens over the long term. Over the last 10 years, the S&P 500 fund has averaged 12.5% a year over the last 10 years, versus the growth fund has been growing a little bit faster. It has grown by 12.6% over the last 10 years on average. So now let's do some math. Let's assume that you invest $1,000 a month into both of these funds, and let's assume that we get these same returns, 12.5% for the S&P 500 fund, 12.6% for this growth fund, but then you also have to pay these fees. If you invest $1,000 a month for 30 years, you would have a little bit over $3.56 million in your retirement account, and this is after paying around $29,000 in fees over the course of the 30 years. But what happens if you're paying higher fees and you're getting slightly better returns? Well, now instead of having $3.5 million when it comes time for you to retire, you're gonna have around $2.7 million in your retirement after those 30 years because you had to pay almost $900,000 in fees. This is a 1.36% expense ratio, not just on how much money you're investing today, but on every dollar that you have invested and every dollar of profit for every year that your money is sitting in this account. So your fees are compounding along with your wealth. But it gets even crazier if you let your money compound even more. If instead of investing your money for 30 years, you invested your money for, say, 40 years, well now in this instance, you would now have a little bit over $11 million when it comes time for you to retire. But here, because you're paying 1.36% in fees with slightly better returns, you're only gonna have a little bit over $8 million when it comes time for you to retire. $8 million is a lot of money, but you're losing out on $3 million just because of this fee. This is why your homework after this video is to open up your 401k account and see what your expense ratio is, because you don't want to be overpaying in fees. And if you are paying higher fees, make sure the returns are justifying the fees. Because what we've seen through history is that in general, high fee accounts do not outperform the lower cost, lower fee, passively managed accounts when you look at it over the long run. Now, for those of you that are investors, one of the things that can also help you get better returns is just improving your financial education and your financial research. And this is where my team at Briefs Media publishes a free daily newsletter called Market Briefs, where we break down what's happening in things like the economy, the stock market, the housing market, crypto, and the global economy into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that are reading Market Briefs every morning. Plus, when you join Market Briefs, you'll also get my investing masterclass free as a bonus just for joining Market Briefs. So if you want to get Market Briefs and my Investing Masterclass for free, all you have to do is click the link down in the description below. I think it's obvious why checking your expense ratio is one of the most impactful financial decisions that you can make, which brings me to the second most impactful financial decision that you can make, which is cutting back on some of your big expenses. The two largest expenses for Americans today are your house and your car. The median housing payment in America today is $2,205 a month. This does not include your property taxes and your insurance. And the average new car payment in America today is $742 a month. This is just on the car payment. This does not include the premium gas that you need now for your BMW. This does not include the oil changes that you need now for your BMW. And this does not include the maintenance, which is a lot more expensive on your BMW. So if you're in a position where you're struggling to find some extra money, one of the simplest things that you can do is start with the biggest expenses and see where you can cut back. If you can find a few extra $100 a month by downsizing where you live, or maybe you can find an additional $700 a month if instead of taking the $8,000 you put down on your car, you drive around in an $8,000 car, and then you take this additional $700 a month and you invest all of that. Well, now this is a way for you to find a few hundred to potentially $1,000 extra a month by finding the big expenses that you can cut back on. Now, it's not fun to cut back. My goal isn't for you to just not enjoy anything in life. I want you to make sacrifices for a period in your life that way you can live the rest of your life without having to worry about money. But in order for you to do that, you have to build your assets, you have to build your investments, and the only way you can do that is if you have the money to invest first. The third most impactful decision that you can make today is to go out and ask for a raise. If you go out and you can secure a $5,000 a year raise from your company, it might not mean much to your boss or your company, but it can change the future of your finances, because if you take that additional $5,000 a year and you invest this additional $5,000 a year, take a look at what happens. Let's assume that you grow your money at below the historical growth rate for the stock market. What we're seeing right now is that the stock market on average has been growing by around 12% a year. Let's assume you invest it and you can only get 10% return a year. If you do this for 30 years, you're adding this additional $5,000 a year into your investments at 10% a year for 30 years. Well, now you're adding an additional $1 million to your net worth when it comes time for you to retire. If we do this for an additional 40 years, well, now we're talking about $2.4 million being added into your net worth when it comes time for you to retire. This is the power of asking for that raise sooner rather than later, and then taking that additional money and putting it to work. That way you have the power of compound interest to grow your wealth over time instead of just taking that additional money and financing that BMW. The fourth most impactful thing that you can do to change your financial life is to create a system for your money. There's three parts to this that I want you to understand when it comes to having a system for your money. Number one is track where your money is going. Number two, never spend more than what you make. And number three, invest your extra money. So let's break this down, starting with tracking your money. If you have not started doing this, one of the biggest financial changes that you can make is at the beginning of every month, see where all of your last month's money went. So you can go out, create a Google Sheet, create a piece of paper, create a financial spreadsheet. I don't care how you do this, but you want to write down at the very top all of your income. Every single source of income that you have, write it at the top of this. And then below that, you want to write down all of your expenses. You want to break this down by category, but first grab your debit card statements, your credit card statements, your bank expenses, and write down exactly where every penny went. It's tedious the first time you do this, but you have to know where your money is going if you want to be able to optimize that. Once you do that, this gives you how much money is left over. Then I want you to write down how much money did you save, how much money did you invest, and then how much money did you give, if you gave any money away at all. Once you do this, you're immediately going to be able to see, oh my God, I'm spending way too much money at Benihana's. And then you can adjust your expenses accordingly. The second thing when you do after you track your expenses is make sure you are not spending more than what you make. This is where you need to have some sort of system for your money. That way you know how much money you're supposed to save, how much money you're supposed to invest, how much money you're allowed to spend. A simple rule of thumb that you can follow is something like my 75-15-10 plan, which says for every dollar that you earn from here on out, 75 cents is the maximum that you can spend. 15 cents is the minimum that you invest. 10 cents is the minimum that you save. This way, whether you're making $20,000 a year, $200,000 a year, or $20 million a year, you're always working to save and invest your money before you spend your money, because that's where the wealth is built. And then, I'm emphasizing this so much that I created this a third time, is you have to invest your extra money. This is where your wealth is made. Your wealth is made through your investments. Your wealth is not made through your savings. Your savings are there to protect you against an emergency. Your savings are there to make a big purchase like a house or a car. Your savings are there to help you buy an investment. But when you go out and you invest your money, this is what you're doing to actually become wealthy. This is what's going to put money in your pocket. This is what's going to pay for your financial freedom. And so when you get that extra money, the key is when you make extra money, invest more money, period. If you do that, you're setting yourself up, your kids and your grandkids up for a life of financial freedom, but you have to invest your money. And the fifth most impactful financial decision that you can make today is taking a risk on yourself. I want you to think of the most successful person that you admire. Who is it? Is it President Trump? Is it Elon Musk? Is it Oprah Winfrey? Is it Jeff Bezos? Who is the person that you admire? I don't care who it is, and I'm not trying to get political here. I want you to just think of somebody who's successful. And one common trait that you will find amongst all successful people is that they were willing to take a risk on themselves. This might be a risk to go out and try to start a business. Invest some money, some time, and some energy into starting that business idea. Investing your money into yourself, into learning how to invest. Investing some money into yourself, into getting a new career, into getting a new job. You have to be the one that believes in yourself before anybody else believes in you. It is hard, but guess what? No one's gonna make it out of this life alive anyways, so might as well try to do something that you feel will give you some enjoyment and some fulfillment and maybe some extra money as well. Go for it. You got nothing to lose. I believe in you. I want you to try things. I didn't grow up thinking that I was gonna make YouTube videos. I wasn't supposed to be doing this. I grew up in a very traditional Indian house. It was so traditional that when I was growing up, my parents gave me two options. When you grow up, you can either become a doctor or you can become a failure. That was it. I didn't have any other options. And my parents were so strict about this that when I was in 8th grade, I was about 12 years old. I was on the verge of failing English class. So my dad got me a tutor. But the tutor wasn't for English. The tutor was for the medical college admission test, the MCAT, the test that you take towards the middle or end of your college career to get into medical school. That was who came to my house when I was 12 years old. I didn't grow up thinking that I was going to be an entrepreneur. I didn't grow up thinking that I was going to create this financial media company. I didn't grow up thinking that I was going to start making these YouTube videos. And I'm not trying to make this video about myself, but what I'm trying to tell you is until you try something, you don't realize what the opportunities are. And it's crazy that sometimes we grow up in this life with blinders on us where we don't see the opportunities out there until you take a step outside of what's normal. And it is tough, it's difficult, but just try it. And the easiest way to start is just to watch some YouTube videos on something that you want to do but have never done before. Maybe it's starting a business. Maybe it's investing your money. Maybe it's getting a new career. Then I want you to do this as well. I want you to invest some money in this as well. That way you have some more skin in the game. I don't care if it's just $20. But invest some money into this. Maybe you go out and buy a book on learning how to be better in this and then take action on it, because there's a saying that goes, those who pay attention. And sometimes you got to invest just a little bit of money. I'm not saying go out and invest thousands of dollars. Start with $20, maybe $100, whatever you're comfortable with, and make a little bit of a financial commitment to learn more about that thing and then take some action and see where it goes. Maybe it's an utter failure, but I guarantee you'll learn something. And now you don't have to worry about living with regret, because at least you tried. Because the people that become successful are the ones that tried and failed and failed and failed and failed and failed and eventually got there, but they kept trying until they got there. And what do you got to lose? So if you're not happy with where you are today with some aspect of your life, change it. What do you got to lose? Being wealthy means your investments are making you enough money to pay your expenses, so you don't need a job to pay your bills. The problem is most people will say, just invest your money into the stock market. But what if you don't know what stocks to buy? Or what happens if the stock market crashes and now your portfolio gets cut in half and you were relying on that income to pay your bills? This is